Greetings, and welcome back to the Rose Bros podcast. This episode, we're joined by Dave Spyker, President and CEO of Freehold Royalties, a TSX-listed energy royalty company with a market cap of approximately $2.4 billion and about 7 million gross acres of land across North America. Mr. Dave Spyker joined Rife Resources in November 2016 as Vice President Production and was appointed Chief Operating Officer in March of 2019. Prior to that, he held various roles at Anderson Exploration, Anderson Energy, and Anderson Energy Inc. Mr. Dave Spyker has over 30 years of industry experience and holds a Bachelor of Science degree in Mechanical Engineering from the University of Alberta and is a member of the Association of Professional Engineers and Geoscientists of Alberta. He also currently serves on the Board of Governors of the Canadian Association of Petroleum Producers. Among other things, we sat down and discussed growing through stressful times, why royalties are a hedge against inflation, the outlook for Canadian energy, and what makes a good royalty. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info at conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, HeadRacingCanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out HeadRacingCanada.com for more info and get your high-performance ski gear for the upcoming season. But if you're ready, why don't we begin? Mr. Dave Spyker.
How you doing, Trevor?
I'm great. Thank you for doing this. I really appreciate your time.
Yeah, looking forward to it. I think it's a good platform to get a little bit more about Freehold and ourselves out into the community.
On January 28th of this year, I tweeted, FRU, 7% yield, no wellbear liability, U.S. exposure, inflation hedged, and low debt. I'd never thought I'd be sitting across from the CEO a month later, so that worked out really well.
Oh, thanks for the tweet. Appreciate that.
Would that, in your opinion, be a good summary of Freehold?
Yeah, I think it's a really good summary, and I think that it's a lot different Freehold today than it was 3-4 years ago. And you know where we've taken the business with just getting rid of all the historical working interest assets and expanding our platform across North America has been a big success for us. I think we really it's really improved the quality of the payors that we have, the exposure to bigger plays in the U.S. I think that are much more growth oriented. We get better pricing, and we've done all that to your point while paying a nice dividend yield and maintaining a really strong balance sheet.
Maybe just to back up to start from the beginning, what is Freehold Royalties?
What is Freehold Royalties? Well, Freehold Royalties started in 1996 actually, and it spun out of this CN Rail pension plan, CNID as it's called. They're still a shareholder today at around 16.5%. What we have is royalty properties across both Canada and the U.S. So we collect royalties on production from our lands. We don't have any capital costs associated with the drilling, the completion, the tying of those wells, nor do we have any operating costs. And nor do we have any end-of-life liabilities associated with abandonment and reclamation. That wasn't always the case when the company started. We did have working interest assets, and so the company was active in drilling wells. It committed about $30 million a year to a drilling program. But like I say, we got out of that business in early 2020. We got we got a handful of wells left on that. So you always see in our disclosure, 80 to 100 barrels a day of working interest assets. But for the most part, we're 100% royalty business now. And what we've really been working on is positioning ourselves, what we see in the kind of best plays across North America and under really good operators that, have a long-term view. So that's where we are today. And with that, we've really strengthened the team, really strengthened the structure of how we do our business. So we're a way to participate in the oil and gas industry without the environmental risks associated with it or without the capital costs. So we're not exposed to all the inflation that we hear about right now.
Engineer by trading.
Engineer by training, yeah. So good, bad, or indifferent, but that's the path I took. Kind of blue collar family, born in Calgary. Went to school in Edmonton. Got a mechanical engineering degree, and that was in 1987. And man, does it go by fast.
Why energy? What attracted you to energy, to kind of take it back a little bit?
It's a funny question because energy is not what I envisioned coming out of school. I'm a mechanical engineer. I wanted to be in the race car business and wanted to go down to Florida, get on a race team. But I'd worked a couple summers at Imperial Oil, and when I graduated, they called and said, "Hey, we just lost a guy. Do you want to come join us?" And I said, "Well, I'm going to school in Florida in the fall, but I'll come join for a little bit." And when you get there, it's just so addictive, right? You realize, wow, energy industry, there's a lot of technology in it. There's a lot of business aspects of it. And yeah, you just got addicted to it and really, didn't pursue the racing career, and I've pursued oil and gas side. And has always been a bit of a tinkerer and a fixer-upper and a builder. I've been really enjoyed that opportunity that's been available in my career to do that.
Did you view it from engineering problem perspective and the interesting problems that are available to solve, or do you view it from a kind of economic opportunity, or a combination of both?
It's a combination of both, and that's the beauty of it, right? You can solve a mechanical problem or a technical problem, and usually if you solve that, it's got a direct link to a financial reward to it, and that's what's quite attractive to the business. And it's unfortunate that maybe the industry's got a bit of a bad rap around some of the new grads and stuff like that, but to come into the business, it's just a huge opportunity set. Even my own kids have got a little bit of exposure to it after thinking that's not where they're going to have a view, and they get addicted right away. So,
and things are going well for Freehold. The Q4 results just came out. If I'm correct, it was a record quarter.
Yeah, well, record year, record quarter, record year, 26 plus year history. This is the highest production levels that we've ever had. It's the highest revenue that we've had, highest funds from operations, most wells drilled on our lands, best pricing that we've ever gotten for our product. So really the work that we've done in the past few years to really change the structure of the company and the focus of the company, really paying off. We really saw all those pieces come together in 2022, and it's been quite rewarding.
It was a year and a half, 2 years ago, in the spring of March of 2020. Things were not good.
Yeah.
If you were to ask yourself then what you thought where Freehold would be at now, did you ever think it would be doing so well?
What we noticed in the spring of 2020 is that when COVID hit, the amount of production that was shut in Western Canada, and we'd already been looking at the US for a couple of years, and we'd done some smaller deals, but there wasn't the same level of production shut-ins. Those assets seemed to be a little bit more resilient. And so, what it did is it gave us more resolve that, we have to expand our asset base beyond Canada. And if we wanted to be sustainable across a broad range of production and commodity price cycles, that we had to diversify our portfolio. So in March of 2020, we knew we had to do something different. And the decision was to really push into the U.S. at that time, and not only do we think we got a more resilient asset base, we also think that we're mitigating the risk associated with some of the political and regulatory risk in Canada. It's a little bit worrisome, some of the word out of Ottawa on how they want to proceed, and you take a look at the other side of the border where recognizing how important energy is, and the IRA system to really support industry and putting capital in place to make sure that we can meet the climate change demands. And so we see U.S. is much more proactive on that. And so I think it's important just to mitigate that. That was our big takeaway from 2020, and we really executed on that.
Energy is a cyclical business. At the time, things were really lousy in 2020. Did you view it as an opportunity to make the business better?
We did. We had... In November of 2020, we had put together a deal to buy, our first bigger suite of assets in the U.S. And, We had conviction, and we issued equity in November 2020 when I don't think there'd been an equity deal for a couple of years, and coming out of the uncertainty around COVID, but it was very well received. Investors right away understood where we were trying to take the company, and we got that placed, and that deal closed in January of 2021, and away we went.
Was that a tough sell, or were people eager to make the investment in energy at the time?
Oh, we were way oversubscribed on that. People got it. And when you look at, the price outlook at the time, those U.S. assets, are generating pretty attractive returns at a pretty low price deck. And so people could see that right away. And, since we did that first deal in the U.S., really our market valuation has really improved, and we've closed the gap, multiple gap to our peers, and a lot of that is that was the first leg of really kicking off a better, more sustainable portfolio.
The best business decisions are long term. How do you reconcile short term, for instance, quarterly demands of the market with good long term business decisions?
Yeah, it's all long term. We can't look quarter over quarter. We see the variability in commodity prices. We talk last spring. Everyone's talking bull run of commodity. We're going to get to $120 oil, and it's going to be there for years, right? And here we are at gas prices have fallen out of favor. The oil prices at $75 to $80 WTI, and it's a different business. And so really when we're looking in it, we think long term, where we want to be long term, and not making quarter over quarter decisions, or you just get caught up in the momentum. So any asset deal that we're doing, has to make sense at a pretty low price deck, just to make sure that there's sound decisions.
In a public company, that can be difficult at times to explain to the short-term oriented investor. Is there a tension there at times, or most of your investors long-term holders, or how does that work?
No, you've always got that tension, and a shareholder can come and go out of the stock overnight, right? Where we have to answer to the long-term business that we're building, and we're living with it forever, kind of thing. And so when we explain that perspective, and people can see how our decisions are aligned long term, I think we get sticky shareholders. We don't tend to see bigger shareholders coming in and out of our stock.
With the ESG pressures on the energy sector as of late, have you had a change in your shareholder base? Are they more niche investors, energy oriented?
No, it's been pretty sticky. One of the attractivenesses of the royalty model from an ESG perspective is that, we don't, even though we participate in the energy industry, we don't have that, active ownership of the assets. We're really just carving off almost a financing type revenue stream, if we want to look at it that way. And so the things that we can control on E is just really who we partner with. And, we're partnering with the likes of the, Pioneers, ExxonMobils, the EOGs. These guys are in the U.S. are well aligned with environmental strategies. Up in Canada, where we've got Tyne as big payers, CNRL as big payers, Payouts and Tourmaline. Like those guys are good companies that are well aligned on that. So that's how we can control the E side of our business. On the S&G, I think we've made great strides in the governance side of the business. Really increasing the board that we have. We brought on 3 new directors last year with so a little bit broader experience base. Two directors are from the U.S. side to really support our U.S. initiatives. And so really we think that the business from an ESG perspective is really well run, really in good hands.
Tourmaline might be the example of the best possible energy company you could find as a partner with Mike Rose, the best management possible. Is it difficult to find high quality companies with the energy industry kind of being gutted by talent in the last few years, or how do you think of it that way?
When we're looking at where do we want to position our portfolio, we're not as focused on the operator immediately. What we want to do is buy the best rock in the basin. So our view is if we can put our portfolio under the best reservoir rock, then good companies will be attracted to that. If there's turnover in there, opportunity, good companies will come in and buy those assets. And so just because we're in the best rock, you get lined up with the best operators. Number one is getting the best rock, and you've got the best amount of go-forward option value in your portfolio.
Do you look for geology-led companies like Tourmaline, where they maybe almost a proxy to good rock?
Yeah, for us, we have most of our portfolio is not in that, that deep basin, Montney, fairway, crown lands. To get a position in there, really you need an overriding royalty. Guys like Tourmaline, they're working with Topaz as their partner company there. But, there's a lot of well-financed people in there. So, it's hard to get a position in those Montney type plays. And so, we see that we can go buy mineral title in the U.S. in, an equivalent quality plays. And that's where we can, position ourselves in some of the bigger growth plays in North America.
Good rock would be, I guess, like we said, a good proxy for a good royalty. But what makes a good royalty to you?
A good royalty to us is a royalty that's got a lot of opportunity set in front of it, a lot of running room. And that has good economics, that it can be developed at $50, it'll be drilled, and it'll be drilled anything above that. And so just that price resiliency. Use a couple of examples. If we look at the Clearwater in Canada, one of the really premier new plays in Canada, be able to participate in that. So we've got a good position in the Clearwater. If you compare that to, say, the Delaware Basin in the Permian in the U.S., kind of same aerial extent, but the pay in the Permian is 14 times more than the Clearwater. So what you get there when you're talking rock quality, you got a good asset aerially, but man, you have a lot more option value in that Delaware Permian, just the stacks of pay. So that's what we look for, so that you've got ability for years and years of drilling as you're just developing that acreage, both horizontally or aerially, if you want to call it that, and vertically, just with the number of zones.
On the other hand, the future is uncertain. Warren Buffett would say a bird in the hand is worth two in the bush. How do you balance winning royalty bids with near-term shareholder returns now, aka not paying too much, basically?
Yeah, it's patience and discipline. We have a view that there's nothing that we need to get tomorrow, kind of thing, and so you can be a lot more patient. We look at a lot of opportunity set. That's again, one thing with the U.S. There's a huge opportunity set down there, and so we can put in our number and walk away. If someone will take that number, fine. If not, then that's okay. I think just being able to be patient when we look at it. I saw a stat last year, and it might be a little out of date with just commodity prices moving, but in the range of $1 trillion of mineral title value is in the U.S. and I think less than 5% is actually in the hands of public royalty companies. Probably close to 40 to 50% is in the hands of private equity that have gathered up this mineral title positions, and still 50% is in individual hands of landowners, ranchers, and stuff like that. And so there's a lot of product trades hands, and so when there's a lot of product, you can be patient. We used to get caught up in Canada when not too much stuff came to market, that there's three of us that are all need that product, and you're in a bit of a cage match and try to see who wins. And but having that kind of broader portfolio or buffet of things to choose from, with that comes discipline and patience, and we think that's a winning strategy for our shareholders.
When you go into a new market, for instance, in the USA, you're not in your backyard, so to speak. Have you found it hard to compete with local operators also looking for royalties in the US when you're going down there? How do you maintain a competitive edge?
Yeah, from the royalty space, it's a little bit different than if you're down there competing on a working interest where you're competing for rigs and talent and people. But on the royalty space, where we found our niche is that we're not out there, knocking on doors and trying to buy that mineral title from each of these landowners. Like, there's people that's their skill set. They've got their trap lines. They've done that for 30 years, 40 years. So it's hard for us to make inroads there. So we're buying at later levels. So people have already aggregated positions through door knocking. They get it to a certain size. They'll sell it, or they'll wait until there's maybe the assets are 30 or 40% developed, and then they'll sell it. And that's where we can come in, so we can be much more efficient in buying it when there's been enough scale of that portfolio put together. It's proven so that we've got revenue and production off it right away, but yet there's still upside remaining, and that's where we found our niche.
In the energy business, upside would be, like we said, geology focused. How much do you lean on the geology side of the business? Is it a huge component in a royalty business so you can capture that upside?
Yeah, definitely. And Canada, where it's much more geology dependent, in the US, where it's thick pay, pretty consistent. Different levels of geologic time goes into it. But how we're set up here, Rob King leads our business development for Freehold, and he's got a dozen professionals in his team. So land professionals, geologists, engineers. We do all that work in-house. So we do all that mapping work in-house, all the type curve work in-house, all the engineering work in-house. And so, that team's been at it together as a group for close to 3 years solid, and some have been working on it prior. But so a lot of experience both in Canada and in the US that we've developed in-house that I think really allows us to tear apart opportunities and compete with anybody on that.
On the other hand, capital allocation is very important. You can have the best rock in the world, but if you don't know how to manage the finances of the business, it doesn't matter. How important do you think capital allocation is?
It's huge. I mean, I think we've seen many a train wreck in the energy industry where capital allocation hasn't been done well. So we tend to be pretty conservative. From a balance sheet perspective, I mean, right now we're at 0.4 times funds from operations to net debt. So, really, really strong position. How we would think about it is that, probably where we like to be is, no more than 1 times debt to funds from operation. We would stretch up 1.5 at most if we had a really clear line of sight to get that back down, using a conservative price deck. From, the dividend is important to our shareholders, and from a retail perspective, a lot of people hold us for that dividend. And so, as we built the company back up over the last several years, we've moved that dividend up as well, paying per share basis back to dividend levels that we were paying in 2015. So that's about a 7% yield on our stock right now. So we like to target kind of that 60% of our funds from operations go back to our shareholders in the form of dividend. The rest goes to balance sheet maintenance, keeping a kitty for acquisition opportunities as they come available. And right now, I think at kind of where we're looking for in 2023, with the kind of the price outlook, we're thinking that we're going to be in the payout ratio will have a 6 handle on it kind of thing, and we're okay with that. Again, just giving a longer term view of the business.
What's your opinion on buybacks? Oftentimes, the whole point is to buy below intrinsic value. Is it hard to make that determination?
I've got a really simple way of looking at buybacks. If I thought we had the perfect portfolio in the world, I'd just keep buying our stock back. But, when I look longer term, again, having that long-term view, I'd say, what? I think there's places that we need to add to our portfolio to make sure that we continue to be sustainable in the long run. And for right now, we see better opportunity to add those components to our portfolio than buying the stock back right now. There's some places that I think are compelling that we think, again, if we want to have a long run life, then that's what we should be doing.
Without giving away your trade secrets, are there certain catalysts that lead to better acquisitions than others? For instance, when someone's ready to sell or when someone goes out of business, are there certain avenues you prefer to go down, or is it all just kind of timely and people come to you, or how do you think of it that way?
Yeah, what we see most of the opportunity set is not opportunities that you generate internally. Like that's a smaller part of our business. A lot of time, we're responding to, marketed processes where an asset is being marketed and it's a competitive bid type situation. So, and again, what we found over the years is most people can probably stack hands on a price deck to use when they're thinking of valuation. Your view of rock quality, remaining locations, the pace of development will really define whether you're the winning bid or not.
Separating yourself from other royalty companies, what do you view as the kind of secret sauce? Is it a good geology stack? Is it good at capital allocation? Is it market timing? Is it kind of it all put together?
Yeah, it's all put together, but the underlying fundamentals is geology stack. You want to be in good rock, and good rock will weather commodity prices. Good rock attracts good operators. Good strong balance sheet. Just maintaining a strong balance sheet will allow you to weather choppy storms, and so that's really how we look at it. So the secret sauce is a long-term view. Get in the good rock, and I think what we're also looking for is, recognizing energy transition is a theme, and the view on the pace of energy transition takes many different avenues. But from our perspective, we also see some good opportunities to participate in that with royalty diversification. So, in minerals and resources outside of traditional oil and gas, just to really buffer the portfolio. And so we've got a team in place that we put together last year that is looking at that. And I think when we first thought about that, we thought, we would get royalties on wind or solar, but that'll never compete with the returns that we get on an oil and gas investment. And so, the team has certainly pivoted a lot more to minerals and resources that, support energy transition. So it's been kind of neat part of last year.
Would lithium fall into that category?
Lithium would be under there, yeah. Yeah, early stage in Canada, just trying to see how that plays out. Helium is another early stage in there that makes some sense as some other minerals that we're looking at. So yeah, those are types of things that look pretty interesting, and we think that there's a bit of a room to play in there right now.
Another way royalty companies compete is on the cost of capital. Have you found it harder to do business with rising interest rates?
It's a bit of a double-edged sword. I mean, clearly your cost of debt is a little bit higher for ourselves, but it also, with the interest costs higher, a little bit more volatility on the commodity price side. We're certainly seeing opportunities come forward in Canada that probably weren't there a year or so ago. And again, when you think Canada, we see to build our portfolio in Canada, you're really relying on a manufactured royalty. So really, you're not buying the mineral title, but you're funding a drilling commitment or funding development on lands with a driller in exchange for a royalty on those lands. And so we see that opportunity set, increasing in Canada more so than it has in some of the previous year or so. In the U.S., that's not what we're chasing. In the U.S., it's a mineral title that we're buying. So a little bit different strategies on both sides of the border.
On the flip side, the reason interest rates are going up is because inflation is super high. Freehold offers inflation hedged protection. On one hand, you have interest rates going up, but on the other hand, you offer a protection against inflation. Has that been a message that you try to emphasize to investors?
Yeah, definitely. We are a hedge against inflation. Our business is not subject to those inflationary costs that the drillers are seeing. We see inflationary costs on our software costs, but it's a pretty small part of our business in the grand scheme of things. The price that we get for the product doesn't matter how much it costs the operator to drill the well. We just get revenue on the product.
Another cool thing about the royalty business is that you can govern or manage a huge asset base North America wide from one floor in Calgary.
Yeah, that's a different. And with technology advancing the way it is in the U.S., for example, the timeline for a well to come on from being permitted or to come on production is much longer than it is in Canada. In Canada, if we see a well license show up, we kind of count on that well being on production in the next 3 or 4 months, kind of thing, the drill completed on production. In the U.S., when we see a well permitted, it can be 9 to 12 months or even longer before it comes onto production. So to kind of track how that well is doing and where it is in its cycle from permit to on production, we track cell phone usage of the frac companies, and so we can see every morning where those frac companies are going by the cell phones, and we go, okay, there's a frac crew on that well right now, so then we can go, okay, we'll expect it to be on production in X amount of time. And so just being able to almost much more real-time monitor your business is pretty cool than it has been in the past.
How important do you see technology in terms of the energy business going forward? We said one floor in Calgary, managing an entire asset base in North America, probably a lot to do with technology. Do you see that impacting the business more, making life easier going forward?
Totally. Like, technology gives us data, and data makes us smarter. And when we're smarter, we continue to make better decisions. And those decisions are on how we look at an asset base, how we think of our planning, how it brings forward opportunities for compliance and making sure that we're getting paid right for our product. Those are all huge benefits of technology, and it's changing so fast. We lean on that to make our business more efficient, and to your point, allow us to operate a portfolio across North America from our one floor in Calgary. We don't have to have an office down in Houston. We don't have to be on the ground there.
Is there a particular part of the technology stack that you see is more valuable or more, I guess, important or helping the company more than the other? Is it data? Is it real-time information?
Yeah, it's data. And the closer to real time you can get that data, the better you are. And so that's really what we're focused on. And it's getting that data in-house and putting a platform in place that allows everybody to access it and look at it, because whether you're if you're in the in the finance team, or whether you're in the business development team or compliance team, that data is helping you guide your decisions, and the higher the quality of the data, the faster it comes in, the more effective you can manipulate and maneuver.
Things are going really well right now for Freehold and energy in general. But on the flip side, how do you define risk for the company? What makes you worry?
Oh, what keeps me up at night? Well, I worry about commodity pricing, and so the commodity pricing you can't control it, but you can manage by where you're putting your plays. So you want to make sure that you're in plays that are going to attract capital across a broad commodity price cycle. I worry about production. We are not a production maker, so we don't control the pace of the production comes on our land. So that's, getting back to this, data and intelligence of trying to be as real time as possible, seeing how development is playing out on our land so that we can forecast it. I worry about cybersecurity. I think we sometimes we think that, we're a little company, we're not a worry, but certainly hearing a lot of our peers have got some cybersecurity is a concern, and we'd be disruptive to our business, so kind of keeps me up at night. But the underlying business, I sleep well with that. It's in a really good spot. It's really resilient. Some of the things that we can't control, whether it's price or pace of drilling activity, or the cyber side, all we can do is just put in good processes, and we've got those.
On the subject of risk, sometimes when the energy industry takes off, everyone kind of goes crazy and starts to raise money, drill wells, and everything gets bid up. Do you have to think about that? Maybe learning from previous cycles, not to overextend the company, and to think about the cyclicality of the industry?
Well, that's one of the beauties of the royalty business, is it works in all cycles. In those times where people are high price environment, people are out there just drilling, taking advantage of the commodity prices, we benefit because production on our land goes up. When commodity prices are a little bit softer and maybe they don't have the same capital available to drill or execute a program, we can come in with a royalty type financing structure and help out there. So we can be active in all cycles, and it helps our business. So that of a business that can win on both times, it's certainly the royalty business.
You've been in the industry for a long time. How do you view the state of Canadian energy these days? Are you positive, optimistic? Are we in the fourth, fifth inning? What are your thoughts on the cycle?
Yeah, I think my view is that we're probably, I'm not the 120 plus WTI kind of guy. I'd be much more that, we're in a positive run cycle, and that somewhere in that fluctuating in that $75 to maybe $100 price range. But over the short term, I think we are going to see some volatility given the geopolitical risks across the world right now. So we can expect that. On the Canadian side, I think we've got the best top tier resources. We've got the best environmental policies in place, the best regulatory policies in place. But there's also some political and regulatory risk with some of the initiatives that we have underway on the carbon capture environmental side of the business. So, a little bit, worried about that, and hence why we like a North American platform that really mitigates that. But, as far as the energy business itself goes, I think we're in a really, really good spot. We have a product that the world needs. We produce it in the cleanest, most environmentally responsible way, and that's important. And I think that in the long run, that will play out in our favor.
Do you think Canadian energy is a answer to clean energy concerns? For instance, natural gas might be a solution for people worried about carbon impacts?
Definitely. We have a role to play, and we can be a big supplier of energy to North America and to the world. The world needs energy from all sources, and so I think oil and gas energy is going to be important, as is a lot of the renewable energy sources that we talk about. But oil and gas is not going to get displaced. Oil and gas is going to remain important part of it. All of us are committed to having a more environmentally friendly footprint, and made tremendous progress over the past number of years. And I don't see any reason why, with the ability to solve a problem that the Canadian energy industry and the North American energy industry has shown year over year, like if there's a problem, there's lots of talented people that are going to solve it. And I think that ingenuity and creative problem solving will continue.
In terms of economic opportunity, what do you think that means for Canada? Energy industry represents schools built, roads built, hospitals built, lots of economic opportunity from royalties and all that. How much opportunity do you think is available to all Canadians? Is it billions of dollars, trillions of dollars?
I would think it's got to be trillions of dollars over a longer term span. And I think that's where, right now, the focus is, from an environmental perspective. But I think, governments will recognize the financial contribution that the industry brings, and that's why I'm confident that we'll find a balance. And the energy sector provides jobs, it provides revenue to build all the infrastructure that you're talking about, and if that slows down, we'll see it, not only across the western provinces, but across Canada as a whole.
You're an energy leader now. Do you have any influences on your style of business or the way you run the companies?
Oh, for sure. I think the company is always a reflection of who the leader is, the style. And my history has always been a builder, fixer-upper, and you really saw that opportunity here. We came into the company in late 2016, with no exposure to the royalty business, came in here and you go, wow, this is really cool. After the first day, you go, what the hell did I do? But by the end of the week, you go, man, there's a lot of opportunity here. And to actually, have that opportunity to work with the powerful team that we have and just kind of mold the company where we are today, super, super happy that we fixed up a lot of the things that shareholders had questions about in Freehold as as the business model changed over the years and what shareholder expectations, we were able to respond to that and really make the company a better company and a much more efficient company and much more suited to the market today. Excellent company when it started. The business model has changed. Shareholders' expectations have changed, and we've been able to meet those expectations with the way that we've molded the business over the past number of years.
From your perspective, how have shareholder attitudes changed? Are they demanding returns upfront more nowadays, or how has that changed from the days of old in the energy sector?
Yeah, the shareholders want those returns, and again, whether it's share buybacks or whether it's how we're managing the dividend, how we're managing debt, those are all, very important. We've seen, the constant, boom bust cycle of the energy industry. And so some investors will sit on the sidelines because of that. But if we can, present a business model that's sustainable through those cycles and be a strong business, pay those dividends, then that's of appeal to them. And we've been in the business for 26 plus years. And so we've been able to build a good asset base, build on it further, got a good track record. We've got a good major shareholder and supportive shareholder in CN and at 16%. And so they can provide their experience and financial support when we need it. And it's been good. Pretty passionate about the company and where we're going with it and what it is. Again, I just think it's just such a much stronger company that will continue to show as we move forward. And we think that going forward, we're going to continue to have record years.
Well, I think that's a pretty good place to leave it. Thanks for your time. If maybe you were to leave the shareholder with a message, what would you tell them?
Yeah, I would just tell our shareholders, thank you for your support as, we've evolved the company, and for any new potential shareholders out there, take a look. And I think you'll find it quite a compelling story. The North American platform has been very effective for us, and we think that we position the company in the best plays across North America, and that will pay dividends, pardon the pun, over the long term.
I know your time is valuable, so thank you very much. Also, a quick shout out to Clark Andrews at Haywood for connecting us. Thanks, Clark.
Yeah, thanks, Clark, and thanks, Trevor, for your time today. It's been an enjoyable discussion.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you like what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.